So today we are going to discuss something on withdrawal rates. Now, withdrawal rate is something which is very important for an insurance company. Now, in this, every month, insurance companies do have certain projections that they are going to have certain number of policies which will not be continued further for next month. Now, this is happening because consumers they have their own reasons to discontinue their policies. So all these withdrawals are going to affect insurance company business because they will not be able to carry on getting their premiums as they were getting in last month. So withdrawal rate is a very important phenomena fixing the pricing of different products. It is important for measuring the sustainability of an insurance company profitability, and it is important because this is futuristic in nature. Now, how do insurance companies to get their withdrawal rates prediction? So it is done on past experiences and changes in condition. Now, withdrawal rates actually, if we define it, it is the probability that a policyholder will not be paying the premium or will be withdrawing the policy. It may be fully or it may be partially done before the maturity date. Now, in this, we have been given one example. In this example, you do have two columns. One is month and then second is withdrawal rates. In month, 13 month, you have 20%. What is this 20% is like? If we have this insurance company is having around 100 policies at the start. So there is a heavy chances that by 13th month, by the time you reach 13th month, you will have only 20% of your policies which will be getting discontinued. So means out of 100 only 20 will be only 80 will be paying the premium. So if we carry on further, we find that by the time we reach 25th month, we have a further scope of 10% more people withdrawing. So again, out of 80, 10% more means 8 people will be discontinuing. So we will be able to get only 72 policy premium. So this is how we have to read this table. Now carry on with the concept. Now you need to understand that there is a concept of surrender value in insurance policies. Now surrender value is something which a customer will be getting in case they are going to surrender the policy before the closure date. Now whether this concept of withdrawal is applicable on surrender policy also, surrender of a policy also. So yes, the answer to this question is yes. Now because these insurance companies are always keeping this thing in mind, there is a chance that there will be certain fixed number of surrenders happening every month. So accordingly, surrender rates are applicable for full year. They do have their projections for full year. It will not be one particular month, but it will be for yearly interval. So they have been forecasted and they are used for computation of your profitability of insurance company. Now, what are the major factors which are important, which will be kept by insurance company in their mind while deciding their withdrawal rates? Now, withdrawal rate, the factors which are there, they are listed here as withdrawal risk, past experience and industry experience, type of product, premium frequency, size of premium, general economic condition, distribution channel, target market, financial awareness or knowledge of your client, geographical orientation of your client, similarly type of premium payment modes available, and competitive situation about the product with various terms and conditions attached to a policy. Now you see, choosing a particular withdrawal rate is very important for an insurance company, because if insurance company will not be able to have a correct approximation of withdrawal rate, there is a chance that this company may go into a financial disaster. So you need to be a little bit conservative. You cannot be extraordinary conservative, but you need to be a little bit conservative. So you need to look little bit onto negative perspective, little bit more, that you will be having more of loss